Hello, this is Eric Boyce, the CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for April 25th of 2022. Please see our disclaimer for important information. Here's our high frequency data, which we did not show you last week. Probably give you a little bit of a break because some of this data tends to move in time frames that you could easily get lost if you watched it every single week. The little minutia changes, but not having looked at it for a couple of weeks, it's clear to see that even despite inflation, that we do have an economy that is pushing forward. Some of the areas that I thought might be a little bit weak, we're actually a little bit stronger than I expected. We've got open table, which is really the only negative data point that we saw both in the week and the month, that seatings and restaurants are a little bit down, but we do see hotel occupancy up. We do see activity, at least on the durable goods front, as it relates to steel production, which obviously impacts housing and construction as well, but also rail car traffic too, which distributes commodities and things like that. We do see rail car traffic and steel production activity picking up. We certainly see TSA checkpoint and gasoline supply moving up higher too, which actually is a bit of a surprise. But you can see the change versus 2019. We're still at a deficit relative to where we were in most of these categories. However, I think it's important to note that hotel occupancy, restaurants, are very, very close to where they were. If you look at the overlay data, like the year-over-year overlays, we're very close in those particular categories. And TSA checkpoint data being lower is simply a function of business travel being a little bit slower to recover here. Here's our Citigroup Economic Surprise Index. Actually, we're seeing a bit more on the positive surprise here as of late. Some of the more newsworthy and noteworthy releases may have given some negative surprises, but when you think about the bevy of data that we process in a given week and in every given month, what this index does is kind of summarize and kind of synthesizes all of that data into this index. And so essentially what it's telling us is that really over the last several months we've seen a bit of an uptick in the amount of positive surprises that we're seeing. Here's our Conference Board Leading Economic Index. It is 10 indicators. You can see that it is quite cyclical. This data series goes way back to 1970, so you can see how inherently cyclical this is. Notwithstanding the lockdown, shutdown with the pandemic, you can see the ensuing recovery. You can see where that LEI is still relatively high. It is rolling off of its peak, but if you look back on this data series, it clearly doesn't stay at the peak very long. It comes back down. But it's important to note that year over year that the indicator itself is up about 6.4%. So indeed, it has not gone negative. So we do have positive leading indicators. And at the next slide, we'll look at the components of that. Here are the components to the LEI, or Leading Economic Indicator Index. You see interest rate spread, which we know is contributory here. Jobless claims, which are down. Credit index, still relatively strong. Work weeks are beginning to expand a little bit, and that's a positive contributor. And we see down at the bottom, obviously, consumer expectations. When you get down into the weeds, consumer expectations is really the big anchor on everything right now with regard to kind of the trend line. We saw that we just a few slides ago, the Citigroup Economic Surprise Index was trending higher. So we are getting positive surprises, but really where a lot of the focus should be placed is on the consumer side, which represents about 2/3 of our economy. You can see expectations right now given the higher prices at the pump, given higher prices at the grocery store, and just the basket of goods that's just witnessing inflation right now, that those expectations are a bit muted right now. Here's our coincident economic index, which is also very important because leading indicators really represent like near-term orders for durable goods and things like that. The coincident is an overlay which tells us kind of where we are right now. And again, a time series that goes back a long time, in this case, 1960. And this is data that comes to us from the Conference Board. And you can see here that, with that interruption by virtue of that pandemic shutdown, that we have recovered and we're really back on pace with this long-term trend line. Now, not that it doesn't come with noise, but I think it's important to realize that, with all of the rhetoric on, inflation right now, which is very apt too, by the way, and we're going to have to monitor what the Fed does and its in sundry impact on the economy, which, interest rates tend to work at a lag on our economy. So, this could turn over a bit. I think the conventional wisdom, it doesn't happen. Within the next few months, but it happens probably somewhere over the next 15 to 24 months. Here's a ranking or lineup from Schwab, which I thought was probably as good a summary as anything right now. So on the left-hand side of this chart, you've got the leading economic indicators, and we just kind of talked about this, but what is the trend? So we know what it's done lately. We looked at that slide, but what is a trend? And that's the far right here. You can see average work week was relatively strong. It expanded, but is beginning to contract now. Labor is getting a little bit more expensive. Really, the areas that we need to be paying attention to: new orders index on the Institute for Supply Management has been trending down. But as we'll see in a little bit, inventories are exceptionally low. And I do think that there is going to be a level at which, even though new orders may be worsening, inventories are going to become so low that the producers will simply have to restock. But there, S&P 500, that's just a byproduct of volatility. And then down below, consumer expectations for business conditions. We just talked about that. That is something that is clearly we're going to need to monitor, but these are expectations. This is not what consumers are actually doing, but this is their expectations, basically reading in the news media, kind of reading the tea leaves, and coming up with their own conclusions. But when you get down into coincident indicators, which we just looked at, this is a real good summary here. Payrolls, positive. Personal income, positive. Industrial production is actually okay, and it's in many cases it's improving. So some of these particular indicators are what we find influencing that Citigroup surprise index that we showed on that first slide. Real manufacturing trade sales improving, and so when it gets into the leading economic indicator, again, ISM new orders, which we know have been trending down a little bit. Consumer expectations has clearly trended down a bit. And then the S&P, which really is almost a kind of a reflection of those things. Here's a overlay of financial conditions. This is the Goldman Sachs U.S. Financial Conditions Index in blue, which is now overlaid in that amber color with the estimated number of Federal Reserve rate increases as we kind of look out over the near-term horizon, put it. So as we sit here in April, financial conditions are getting a little bit tighter at the same time that the number of rate increases is continuing to move higher. Now we have a couple of what kind of interesting charts here. We've talked a lot about shipping over the last year. particularly over the last 9 months. And here we have the Baltic Dry Index. And so this is basically bulk freight shipping over water across the globe. And where we see these prices spike really towards the end of last year. And it was a significant problem. We saw those prices moderate. Now they have come back up, but they're settling in at a range that's above where they were really during the pandemic. But it seems to be a healthy range right now. But we have seen a tremendous decline overall point to point if you literally go back 6 months. Here's a tweet that I just decided to copy, and it's in total here from Liz Ann Saunders at Schwab. But the cost of freight is actually going down. We just saw that in the Baltic Dry Index that the freight costs, at least relative to towards the latter half of last year, have definitely gone down. And here too, you can see a 40-foot container ship cost shipping from China to the port of LA has gone down for 8 straight weeks. And if you actually go back to really the September, October of last year, you can see the preponderance of large declines. So this really does correspond with the Baltic Dry Index. Again, if you take these two in sum, what it tells you is that overall freight and shipping costs have clearly come down off their peaks. Well, here's the ISM, Institute for Supply Management, Manufacturing Purchasing Managers Index. That's a mouthful. That's in the red. We can see that that's rolling over, but this is a diffusion index. On the right-hand side, you can see that that number is still kind of in that 55 to 60 range, and anything above 50 represents expansion. Now, utilizing the left-hand margin is what we see in the blue, and this is the Philly Fed 6-month forecasted new orders. And so, and it's advanced 6 months. So basically, we're showing, what the expectation is through, pretty much the end of the third quarter here. And that's clearly going down. So new orders, this is, remember when we looked at that lineup, all of the LEI components and ISM new orders. Well, this is it right here. So ISM new orders have really cratered lately. And again, those two things that were very influential, the consumer expectations and then the ISM new orders. So that's down. So, looking at the tightness of this data set, the relationship between these two series of data, it would seem to incline that you get ISM manufacturing PMI going down. It seems fairly intuitive. If your orders are going down, then your production is going to go down. I do think there is a limiting factor right now. Sentiment is pretty weak just because of inflation, and there's a lot of anxiety over whether the Fed can engineer a soft landing versus a hard landing. And there's just a lot of anxiety over whether we have achieved peak inflation now or not. I think I would argue that we probably have, but there's still a lot of anxiety out there. And so these new orders reflect that. And so when people are a little less confident in the pace of things, that they will tend to pull back new orders. And I think that's what we're seeing here. And I think at some point you'll see that kind of level out and maybe not become terribly strong anytime soon, but at least level out. And then you'll find kind of the ISM manufacturing data and the Philly Fed 6-month forecasted new orders begin to coalesce probably right around that 50, 52 level. On that right-hand side. So, very modestly expansionary, at least during the interim, but not anything robust, and certainly not as bleak a forecast as this might suggest. Here's an overlay I thought was really interesting. Ran into this on Twitter, and it's an overlay of commodity prices in the dark shaded line against the China imports. And these are year-over-year data points. And so you got commodity prices on the left-hand margin, you got China imports year-over-year, and the right-hand side. And obviously, China imports have dropped. China's in a lockdown right now. And the author of this piece, this Andreas Steno, using data from Macrobon, is trying to imply this relationship here, and that with China imports going down, that commodity prices should fall at some point, and they're exceptionally strong. And you can see the deviation in this data series now. And if you go back to 2004, this relationship has actually been pretty tight. There's a pretty tight correlation here. So it's odd to see such a stark deviation, but the argument is that commodity prices are going to settle out. And I actually do think that there's some truth to that, because things have been bid up so much that, especially if you include oil and some of the distillates in that are exceptionally high, that it's only fair to assume that you're going to have some commodity price growth moderation. Now, I inserted growth in there because I'm not sure that you necessarily have outright declines in commodity prices, but I think the rate of growth is apt to slow a little bit. So this is a more kind of data set overlay, looking at interesting patterns here. And so in the blue, you see household net worth as a percent of disposable personal income, okay? Net worth as a percent of disposable income. And then in the amber colored line, you have University of Michigan sentiment. And then you tend to ask questions, there's the consumer confidence number that comes to us from the Conference Board. Then you get the University of Michigan sentiment number, which is produced obviously by the University of Michigan. And they ask different things. And so the Michigan index tends to ask survey respondents a little bit more about their theories and feelings on inflation. So obviously sentiment in that regard is lower, and you clearly see that reflected in this. But what's really kind of odd is in the blue that household net worth, households are exceptionally strong right now. Obviously, people that own their own homes have a lot more equity in them because of price increases. And we know incomes are going up, even though purchasing power is struggling and real incomes are actually negative. But households are in, by and large, really good shape, and so it does create a bit of an odd situation that you have sentiment that is cratering at the point where you've got personal net worth essentially looking really strong. Here's a quick check-in on the GDP consensus estimates, and this is real GDP. So this is reflective of inflation. So you can see in the U.S. And you can see, frankly, in all areas, whether it's EU, which we have anticipated clearly because accelerating perhaps because of the Russia-Ukrainian conflict and its dependence on energy. But you can see the U.S. The amber line, and then China. This will be an interesting development. So China is in that black line up above, and so we know China's slowing, and obviously they're in many places still in a lockdown situation now. And not too surprisingly, I put these on here. This is the CPI, consumer prices, PPI, producer prices, both of which are moving higher, as we very well know. Producer prices, I think, fair to say that we're already trending higher, even last year. So, I mean, the price increases that we're seeing now and the trends that we're seeing now have been in place for the last year. So this is not a surprise to us. And you look at core, obviously core prices are moving at a similar direction as the all-in index is moving, and obviously core prices just reflect basically the all-in number less food and energy. So we clearly see that moving higher. And switching back to the CPI, looking at what are the categories that are influencing the CPI right now, and I think it's healthy to look at this. When you look at the kind of the amber bar in the middle, that's the all-in CPI, and we know that that's been fairly robust. But look at fuel oil, gasoline, used cars, airline fares. We know natural gas is at an interim high. And then, things that you buy at the supermarket, meats, poultry, et cetera, new vehicles. All of these things are influencing the CPI higher, whereas you have things that are weighing against that, like apparel is increasing, food away from home. We know that there's some pressures there, motor vehicle maintenance, repair. Rents are low, but they have been moving higher. And then basically you see the areas here that are maybe detracting from overall CPI growth, and you see these areas at the top part of this chart that clearly are contributing to inflation right now. And I wanted to put this chart in there. It shows going back to 1976, Fed basically rate tightening cycles. And those of you who are around in the late 70s know about the kind of the period of stagflation that we had, and then inflation really took hold, and Fed Chairman Volcker stepped in the early 80s and said, we're going to raise interest rates aggressively to tackle this inflation. Well, they certainly did, and it led to a cycle that persisted until the end of that decade, really. And then you see the ensuing business cycles there. And so the last one on this, on the right-hand side, reflects where we are in terms of Fed funds rates and where we are after that little shock recession that we had in the pandemic. So we're just barely coming off the bottom, and you could see rates during more normalized business cycles, previous cycles. If you back out the one that followed the global financial crisis, we clearly are behind the curve here in terms of raising rates. And so it took us a long while after the global financial crisis to come off of the zero bound. But I think clearly with the inflation that we have now that we didn't have then, it's requiring a more robust response. And to this whole notion of, can the Fed engineer a soft landing? And and this chart really is the same chart that we just saw, but it just overlays these little yellowish bands here, and these represent really the 3 times over this post-war period. I say war, I'm talking about World War II, where the Fed actually was able to generate a soft landing. And so more often than not, we do see periods where, we have a recession. Again, recessions are normal. They're a part of the business cycle. The pendulum rarely rests squarely in the middle for a long time. Usually it swings from side to side, spends a lot more time in expansion than it does in recession. But, recessions are a part of the natural economic framework of our country. And so, the challenge for the Fed right now is to engineer rate hikes that don't slow or stall the economy into stagflation, which, could be a predecessor for a recession. But, again, the last time that we were able to avoid a hard landing was in 1995. And so all eyes will be on this particular concept here over the next, probably really the next 2 years. Well, here's some data looking at the unemployment rate, which we know is going down, long-term equilibrium on unemployment. Again, labor is exceptionally strong right now, which is driving wages higher, but there's still, maybe 1.6, 1.7 jobs for every unemployed person out there. So it's not like there aren't options. And so you can see the labor market getting ever so tighter. Jobless claims show a lot of resilience, and this is data that comes to us via FS Investments, which does a really super job of analyzing the data here. And you can see Delta and Omicron really just had a very minimal impact on jobless claims and didn't really disrupt the economic recovery at all. Here's, again, looking at inflation overlaid with the PCE deflator, which is a very good proxy for inflation. Personal consumption expenditures is what the Fed looks at as far as inflation goes. And then, looking at the basket, and we showed this to you a couple of slides ago, but the basket of things that are influencing consumer inflation right now. And when you look at the headline, which is in the black, obviously that's moving higher. But if you look at really and go back to that slide, fuel costs, gasoline costs, much, much higher. That's in the amber line here. That's moving much faster, as is food, than the other items. And so this chart from FS is basically highlighting the fact that necessities, whether it be food and energy, are really the big drivers of inflation right now. And when we can find a way to tackle that, that's when we get real relief from inflation. Or, we raise rates, tighten credit, and it just simply curbs demand for those things. That's when you're going to see a material change. Here's household sentiment. And this is alluding to what I mentioned before. So we did that overlay, and we showed you the University of Michigan consumer sentiment. Well, this is deviated from the Conference Board consumer confidence number. So essentially, the Michigan consumer sentiment number tends to get into the weeds a bit more on inflation and inflation expectations, where maybe the Conference Board, the consumer confidence level, it really spends more time on the labor situation. So two different angles to arrive at at basically a similar type sentiment number, but we've seen a huge deviation to date just because inflation's picking up, and that's really on the minds of respondents to this Michigan survey. And one of the things that is kind of maybe less salient, certainly poignant over the long term, is this real wage issue. And so, you can see that it's been quite a while since we've struggled with negative real wage growth. And with inflation moving higher, that's putting pressure on nominal wages and turning them negative. In fact, the spike in inflation lately has made that real wage growth even more negative. And so eventually this will begin to weigh on consumer confidence. This is, one of the things that the Fed is certainly paying attention to, even with full employment. But price stability is such that, the wages aren't keeping up, and obviously that will have an impact on the ability for consumers to consume. And again, consumption represents 70% of the economy, so that's why that's important. Here's a quick check-in on the Fed funds rate expected by the end of 2022. And, I think, there's more fairly strong rhetoric out this week from Fed Chairman Powell that they're going to go a half percentage point when they meet here in really literally a handful of days. And so this is showing us that we're essentially going to get another 10 to 11 rate hikes by the end of the year. Again, a very aggressive tact. In fact, there is actually positive probabilities that we get 0.75% increases in both the May and the June meetings because of the recent inflation data. Might be a little far-fetched at this point, but it is being considered, in the range of outcomes. And so again, this is symptomatic on the left-hand side of a Fed really of sentiment that seems to assume that the Fed is going to be super aggressive in fighting inflation. On the right-hand side, we just simply look at yield curves. Looking out, if you start from the left on this right-hand chart, that's obviously very short-term rates, and those have clearly gone up. But even on the right-hand side, you can see, at the end of October last year, we kind of had this flat front-end curve and then had positive sloping out, when you get past really 1 year. Well, now that's kind of flattened out. And if you look at that amber line on the right-hand side of this chart on the yield curve, you see how flat it's become. And so when you get to the 1 year and the 2 year, and then you see a point which we're at right now where the 10-year has gone slightly negative. Excuse me, the yield curve is inverted a little bit, where you can see the 10-year slightly below the 2 and the 3 year. That's symptomatic of a environment where the the market expects some slowing in the near term, or excuse me, it's slowing in the intermediate term, I should say. Here's a look at the inflation expectations. They call it the 5-5. And so this is a 5-year forward inflation expectation 5 years out. And so we've shown this to you before, but I show it to you again because it has continued to grow. And we clearly see inflation expectations longer term, despite the fact that we have expectations for significant rate increases this year. The longer term inflation expectations are moving higher. Again, in the aggregate, what we're talking about here is 2.6%, which, when you think from a financial planner's perspective, the long-term assumed inflation that financial planners use for decades was 3%. And so this is obviously below that, but you can see the pace at which inflation expectations have moved really literally in a matter of months. We've come from just over 2% to something closer to 2.6. Here's a quick look at nominal GDP growth versus the change in margins. And so, we look at corporate margins. We know that they have been high and they've been jockeying around, peaks for several years now, and then obviously having come off their peaks with the inflation cost push that many producers were seeing. But we see margins just ever so slightly rolling back over from the change year over year decelerating, I should say. And then you've got nominal GDP, which is on the year over year basis. On the right hand side, you can see it spiking back up, and there's a positive relationship here. It's not incredibly tight, but I think the implication here is that you're going to have some kind of equilibrium point between these two things, where corporate margins and nominal GDP are going to move at some point kind of more hand in hand. On the right hand side is something that I have alluded to at least twice in this broadcast today, and this is the inventory to sales ratio. All right, so inventories divided by sales, and a number that is going down here shows you that inventory levels are really paltry right now. And this goes back a long time, 1960, and this number's never been this low. And so what it tells me is, even though you have inflation anxiety, you have ISM manufacturing new orders look a little bit soft. You've got consumer sentiment eroding. At some point, if you continue down this path, you're going to have to restock your inventories, and that's going to be kind of a natural limiter that you're literally going to have, retailers and distributors that aren't going to have enough inventory to even supply, a lower level of demand. So I think that's important to remember here. Here's a look at 30-year fixed mortgage rates. We're going to talk about residential housing and related topics here for a couple of slides. So you've got the 30-year fixed mortgage rate, which we know has moved exceptionally higher. We now see 5% really almost across the board, and we see the affordability index in that black line. So this is inverted. So it's actually affordability is going down. And you can see the relationship there, and it is positive. It's not a really tight relationship, but clearly affordability is moving down at a time where mortgage rates are moving higher. Now, on the right-hand side of this chart, I have mentioned this in conversations and on these broadcasts many times, that we went through essentially a decade of under construction in residential real estate. You can very clearly see that after the bubble that was the global financial crisis and the real estate market fell out. You get into 2010 and then basically supply cratered. And it really, the low point was around 2013, when we were not building hardly any homes. I shouldn't say that, but we were building far less than we were than before the global financial crisis. And so at that time, obviously populations continue to increase. You tended to have more labor mobility. People were moving around into, from, higher tax entities to lower tax jurisdictions. And then, so the industry was struggling to catch up. And so really when you look at this point to point from like 2009 to 2019, we really did underbuild and we went through a decade of decreased supply at a time where, looking back on it now is clearly needed because the manifestation of all of those years of underbuilding is just simply the high price environment that we have now. And you can see, even though we're struggling to catch up, this chart shows you that not only do you have a lot of projects not started, we've seen a bump in that because supply chain choke points, people are looking for windows, siding, lumber, steel, trusses, things like that. But you also have a lot that's under construction that's in the pipeline now. So here's an interesting chart I came across. I have never seen this depicted before, but in the blue line, it's existing single family homes year over year sales change for $1 million houses and greater. So just think about that year over year change in sales of $1 million plus homes. And the amber line represents the year over year change in homes that are priced between 250 and 500,000. You can see those with affordability trailing off. You can clearly see that that the sale of those level homes are going down. Obviously, prices are moving higher, so net there's just less supply at this price range. But you can see that the number of $1 million home sales year over year is still pretty high. You can see that the in between these two data sets currently you see zero, and that reflects a positive or negative, the point at which these sales are positive and negative. And so $1 million plus home sales are still up 24.6 year over year, whereas 250 to $500,000 homes are down almost 28% year over year. And not too surprisingly, mortgage rates moving higher. This is from Redfin on the left. It's the fastest annual mortgage rate change in history. Rates are above 5% now. We have honestly never seen a rate change this fast on a year-over-year basis. In this data set goes back a long way as well. And as a result, on the right-hand side, here's the Mortgage Bankers Association index, the MBA index of home mortgages, single-family residential mortgages. And we see that mortgage rate really tumbling because rates are moving higher. People are holding off. Affordability is a little bit less. So I think we do, the takeaway from this is, perhaps that we're going to see some, at least at a minimum, moderation in the rate of growth in home prices. Here's a quick look at the U.S. existing home sales median price year over year change. And then the amber line represents the University of Michigan buying conditions. So we know buying conditions are moving down. We've kind of talked about that. Home affordability eroding on the heels of higher prices and higher mortgage rates. And then you can see the home price change, again, 15%. That's where we are. And you can see really over the last, going back to the pandemic, during the post shutdown environment where we have this acceleration quite a bit. You can see over a longer period of time, if you back out the global financial crisis, in which prices absolutely cratered, you could see the bubble leading up to the global financial crisis is actually less than where we are right now. So the question is, are we heading into a housing bubble? And like I said, I do think, we don't have the same circumstances that we do now. Banks are far less, their balance sheets are far less asset sensitive, which is meaning they're far less sensitive on their liabilities, I should say, which are deposits. So banks are in generally much better health than they were back in on the eve of the global financial crisis. But it's interesting to look at this relationship of buying conditions being so low right now at a time where we're still witnessing 15% price growth. And here's an interesting chart pulled off of some research by Fidelity. And so what you see here in the black line here is essentially the U.S. equity market cap, which is now about $38.3 trillion. In that in that violet line, you can see the Barclays aggregate market cap, which is about $25.8 trillion. And then below that, you see basically in kind of the yellow, you see bond flows for mutual funds and ETFs, cumulative flows since 2009. And then basically the other component of that represents equity mutual fund and ETF flows. And so, the argument here is that you've got a tremendous amount of bond flows that have gone into the market after the pandemic. You can see on the equity side that flows have really slowed up at a time where market cap is really kind of soldiered ahead, which kind of an interesting relationship. So bond flows weakening at a time where the market is strengthening. Well, obviously we're in a different regime now, but we've reached a point actually of kind of peak money flows into bonds, into bond mutual funds and ETFs. And you can see that kind of that line just beginning to roll over now. And you're seeing more flows into equity, ironically, at a time where we're seeing a lot more volatility. So, the Fidelity's argument, which I think has some merit, is that if you continue to see bond market outflows and equity market inflows, that you can actually sustain the equity market uptrend, the general uptrend. Again, more volatility likely, but a general uptrend for quite some time because of the magnitude of these flow changes that we've witnessed, going back, several years now, and could be quite sustaining to an equity market that is really trying to find its footing right now. And here's another chart from Fidelity, which I thought was really interesting. And the black line that represents your S&P 500 index. You can see the volatility that we've had lately. And down below, you've got essentially, a couple of important things. You've got in that yellow line, it's earnings growth year over year. And then in the kind of the light blue, you've got price to earnings ratio year over year. And so we know we've had multiple contractions. You can see that, as we get into the beginning of this year, you can see we've had PE contraction really almost by 25%. I mean, a really strong contraction in price to earnings multiple. So the value of the market itself has gone down, because earnings have been pretty strong. You can see that flip-flop there. And so earnings have been really strong. Obviously, coming out of the pandemic, the year-over-year comparisons were outstanding. But, what this chart is arguing for is that, we saw about the time that we saw the market begin to roll over and correct a bit, that we saw a peak growth in earnings. And now we're at a period where earnings are still going to grow. They're just not going to grow at the same rate. So we've kind of rolled off peak earnings at a time where the market is particularly cheap relative to where it's been, really over the last, several years. That price to earnings multiple down is, down below 19, which is providing, I guess the feeling is that the market has a little bit more value to it if you can get, like, say, what I mentioned in that last slide, you get more equity flows into the market. And here, I think, even with earnings growth peaking and rolling over, as long as it remains relatively positive, even in a weaker economic environment, it does lay the groundwork for a positive market growth overall. But not all boats are going to float the same way. This is the Goldman Sachs non-profitable tech index, and I use this as really kind of a rough proxy of some of the areas of the market that aren't performing well. And so this part of the market, obviously technology, which would actually tend to be expected to do well during a rate tightening cycle, and has historically. But in here, we're showing non-profitable tech companies really weakening now, and we've seen a complete reversal from 2020 in just overall non-profitable companies versus profitable companies, and non-profitable companies are really struggling right now, and then even amongst profitable companies, we're seeing a relative divergence in performance from those who pay dividends that are performing better than those who are not paying dividends that are still nevertheless profitable. But here, this is emblematic of a trend that I think is going to be pretty well entrenched over perhaps the next, probably the next 24 months or so. Here's we've been going back to the University of Michigan consumer sentiment number. Again, these are folks that are being asked a little bit more about what's going on, their thoughts on inflation. You see that in the blue line. We know sentiment is rolled over because inflation's high, and at a time where we've got an asset allocation, and this is the American Association of Individual Investors, AAII. The allocation to equities still remains pretty high at a time where sentiment is relatively low. And this data series is actually has a pretty reasonable correlation. So it's odd to see this massive divergence here. But does that portend more rotation into equities? This seems to perhaps belie the chart that we saw from Fidelity a couple of slides ago that would seem to suggest that bond market outflows are going to go into equities. But I think it's an unknown question at some point. And again, these things can diverge from time to time, probably not to the magnitude that they have. But I do think they coalesce around kind of an equilibrium point at some point. And I think probably Michigan consumer sentiment, as I've already said, is likely to kind of flatten out and kind of become a little bit more muted and not decline so much. Now that's that. So on the right-hand side, we've got quarterly guidance and CEO confidence, another one of these weird anomalies that we're dealing with right now. So you've got current guidance in the quarter that we're in now going down, and we know that. Slowing economy, slowing rate of earnings growth, very well understood, no surprise there. But what's odd here is that we've got the C-suite, basically CEOs, COOs, CFOs, all the C-level executives, their confidence factor is actually pretty high. So even though guidance is low, confidence is high. There's several ways to read that. Maybe, okay, we've got this transitional period where we've got a new rate tightening cycle we're going to have to navigate through, but our longer, intermediate, and longer term expectations are actually pretty high. That could easily be one explanation. But I did think it was interesting, these two data series that typically have a reasonable relationship with one another are just so divergent right now. And as we look during tightening cycles, we always are trying to be cognizant of, the areas that tend to perform better. And now, I think the overarching comment here on this slide is that during interest rate tightening cycles since 1990, the market has increased on average about 7% a year. And so the market has increased. That's the takeaway. So we know valuations are lower. Even though earnings growth is slowing, market growth during rate tightening cycles dating back to 1990 have tended to be positive. Now, where we get the most juice is in energy, utilities, which not surprisingly is the areas that are doing well. Technology tends to do very well, which I mentioned I think on the last slide. Areas that don't do so well: industrials, financials, and then discretionary materials, staples, and then telecom are tend to underperform here. But where we also see positive performance, and this chart is a little hard to glean this, but you've got the MSCI EFA index, so the international indices, and emerging markets tend to actually perform a little bit better than even the S&P does. So I think the takeaways here is that once we get through a period of transition where I think everyone is coalesced around this thought that the economy is slowing, orders are slowing, earnings growth is going to be a little bit more muted year over year. I think there is a backdrop, at least until there is some form of recession, again, perhaps 1.5 to 2 years out, where equities can kind of perform during the interim. And something I always love to show clients and remind them of. So, when you live in a world of volatility where data is almost instantaneous and we get so much in our, social media, news feeds and things like that, it's almost data comes at us too fast. Well, it's always good to remind ourselves when you have a bad day, and we had a bad day on Friday. That was a pretty ugly market. That 46% of the time, you're likely to witness a negative return on any one given day. If you just look at it one day. Now, if you look at it, over a period of a month, then you have a 38% chance of having a negative return over that month. And again, the whole idea here is if you have a longer term horizon, those types of markets that we had, like say last Friday, become much less important. When you get into 1 year, you only have a 25% chance of having a negative return. Now, obviously, there are some years that when you do have a negative return, that does stick out, but you only have basically a 1 in 4 chance of having one. If you go out 3 and 5 years and 10 years, if you have that kind of horizon, you have basically only a 6% chance of having a negative return over a 10-year rolling period, and that's pretty powerful. And when you talk about financial planning, this is the kind of data that is really important to remind yourself of, that when you get out and extend your horizons, then you should be, obviously you pay attention to markets like we had on Friday, but you don't get caught up in those very much because you know that over time that tends to mute itself out. Well, that's all we have for the broadcast today. Hope you've enjoyed it. In behalf of the entire team at BKA Wealth, I hope you have a wonderful week, a safe week, and we look forward to talking to you again soon. Take care. Bye.